Debt is usually painted as the villain of personal finance, the thing that keeps people awake at night and traps families in endless payments. But what if the same tool that causes stress for millions is quietly used as a wealth-building weapon by the richest people on Earth? And what if the rules are not actually the same for everyone? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. When most people hear the word debt, they think of credit card bills, student loans, or mortgages that take 30 years to pay off. Yet behind closed doors, billionaires talk about debt very differently, almost casually, as if it were not a burden but a lever, and understanding why that difference exists is the first step to seeing the hidden mechanics of modern wealth. To understand how billionaires use debt to get rich, we need to go back to the origins of lending itself, because debt is not a modern invention. It dates back thousands of years to ancient Mesopotamia, where farmers borrowed seeds and tools, and even then the powerful understood that controlling debt meant controlling resources, influence, and future growth. As societies evolved, debt became formalized through banks, interest rates, and contracts, and during the rise of industrial capitalism in the 18th and 19th centuries, wealthy industrialists learned something critical. Borrowing money to build factories or railroads could generate returns far greater than the cost of the loan, as long as the borrowed money was invested into something productive. This idea laid the groundwork for what we now call leverage, which simply means using borrowed money to amplify results. And, while leverage can magnify losses, the wealthy learned how to shift that risk away from themselves through structures, diversification, and political influence, something ordinary people rarely have access to. Fast forward to the early 20th century, when figures like John D. Rockefeller and Andrew Carnegie were building empires. And you begin to see a pattern. They borrowed aggressively, but not for consumption. They borrowed to acquire assets that produced cash flow, assets that paid for the debt itself, and then some. Here is where the story takes a turn that surprises most people, because debt by itself is not what makes billionaires rich. It is the type of debt, the timing of the debt, and who ultimately carries the risk. And this is where the financial system quietly starts favoring those who already have wealth. Banks do not lend equally to everyone, and this is not a moral statement but a structural one, because banks prefer lending to people who already have assets, stable cash flows, and political connections, which means billionaires can borrow billions at lower interest rates than an average person can borrow a few $1,000s. Imagine two people walking into a bank. One has no assets and wants a loan to start a business. The other already owns companies, real estate, and stocks worth hundreds of millions, and even if both want to invest, the second person gets cheaper money, fewer restrictions, and more flexibility, and that difference compounds over decades. One of the most famous examples is real estate, where wealthy investors use debt not as a last resort, but as a core strategy. Buying properties with borrowed money, letting tenants pay the mortgage, and watching inflation slowly reduce the real value of the debt over time while the asset itself appreciates. But here is the cliffhanger most people miss. If debt is so powerful, why does it ruin so many lives? And why does it seem like only the rich benefit from it? And the answer lies in what happens when things go wrong. During economic booms, debt looks harmless, even genius, because asset prices rise and cash flows stay strong. But when downturns hit, leverage turns dangerous. And history is full of moments where excessive debt caused massive collapses, from the Great Depression to the 2008 financial crisis. In 2008, banks and investors had used enormous amounts of debt to buy housing-related assets, assuming prices would always rise. And when that assumption failed, the system nearly collapsed. But here is the twist. While millions of ordinary people lost homes and savings, many wealthy investors were bailed out or had enough diversification to survive. This was not an accident. It was a reflection of how risk is distributed in the system, where losses are often socialized and gains are privatized, meaning the public absorbs the shock while those at the top retain long-term advantages. After the crisis, governments promised reforms, stricter lending rules, and better oversight, but instead of eliminating leverage, the system adapted. Interest rates were pushed to historic lows, making debt even cheaper for those who could access it. And once again, billionaires positioned themselves to borrow at scale. Consider modern tech billionaires, who often hold massive amounts of stock but very little cash, and instead of selling shares and paying taxes, they borrow against their stock using loans backed by their assets, which allows them to access billions without triggering taxable events. This strategy is often summarized as buy, borrow, die, where assets are bought, then borrowed against repeatedly, and eventually passed on to heirs with favorable tax treatment, effectively allowing wealth to grow across generations with minimal taxation. For example, if a billionaire owns shares worth $10 billion, they can borrow $1 billion at a low interest rate, live off that money, and let the remaining shares continue to grow, and as long as asset growth outpaces the interest, their net worth still increases. This is where debt becomes almost invisible to them, not a monthly bill that causes anxiety, but a line item managed by teams of lawyers, accountants, and bankers, all focused on optimizing outcomes, something far removed from the everyday experience of debt for most people. Yet this strategy is not without risk, and even billionaires face breaking points, as seen in cases where over-leveraged empires collapse due to sudden market shifts, regulatory changes, or miscalculations, reminding us that debt is a double-edged sword. One dramatic example is the fall of leveraged hedge funds and property empires that seemed unstoppable until liquidity dried up, forcing fire sales and exposing how fragile even massive fortunes can be when built on borrowed money. Still, the fallout rarely looks the same for the ultra-wealthy as it does for ordinary borrowers, because they often have access to restructuring, political leverage, or negotiated settlements, while average people face foreclosure, bankruptcy, and long-term credit damage. This repeated pattern raises uncomfortable questions about fairness, opportunity, and whether the system is designed to reward financial sophistication or simply existing wealth, and whether the same strategies can ever truly work for the average person. In today's world, debt is everywhere, from student loans to national budgets, and the total global debt has surpassed hundreds of trillions of dollars, a staggering figure that mirrors past periods before major economic corrections, suggesting we may be repeating history once again. Modern parallels are easy to spot. Low interest rates encourage borrowing, asset prices rise, inequality widens, and many people feel left behind, while those who understand leverage continue to pull ahead, setting the stage for future tension and possible disruption. So what does all this mean for someone watching this video, who is not a billionaire? Does understanding how the wealthy use debt help or just frustrate? And the answer depends on how you apply the lesson. The first takeaway is that debt itself is not inherently good or bad. It is a tool, and like any tool, its impact depends on how it is used. Borrowing to consume depreciating items often leads to financial stress, while borrowing to acquire productive assets can, under the right conditions, build wealth. The second takeaway is that access matters. Interest rates, terms, and flexibility dramatically change outcomes, and this highlights why building assets, creditworthiness, and financial literacy early can expand options later, even if the scale is very different from a billionaire. The third takeaway is a warning. Leverage magnifies everything, including mistakes, and history shows that periods of easy debt often end abruptly, so caution, diversification, and long-term thinking are essential, especially when markets feel unstoppable. As we look ahead, the open-ended question remains: will the system continue to reward those who master debt, or will future reforms change the rules? And more importantly, how prepared are you for the next shift when easy money disappears? Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.